Welcome. Happy New Year. I hope that you had a meaningful and memorable holiday season. I've been asked a lot about what's going to move the market in the year ahead. So in today's video, I'm going to touch on in sort of bullet point format a few of the major drivers of the market in the year ahead. I could talk for hours about each of these, but I just want to put a few of these ideas in front of you as we move into the new year. Let's take a closer look. We enter 2026 in a similar position as a year ago in that market valuations are at elevated levels. What we see in front of us is that the price to earnings ratio of the S&P 500 is currently at 22 and a half times forward earnings, which is a very high level. That high valuation level, though, in some ways is justified by very strong corporate earnings. We've seen a substantial rebound in corporate earnings growth over the last year, with the latest quarter showing 13% year over year growth, which is a very strong number. In order for that earnings growth to continue, we must see productivity gains. And as of late, we have. Over the last year, we've had 3.3% productivity growth, which is well in excess of the 1.8% we've averaged per year so far this decade. Whether it's due to productivity gains potentially beginning to displace jobs, or whether it's just a general slowdown in the labor market, we have seen an increase in the unemployment rate, still at very low levels, but off of the all-time lows from just a couple years ago. As the labor market softens and the unemployment rate gradually ticks up, that could begin to put downward pressure on prices as there's less of a demand for products and services. This is certainly the hope of the Federal Reserve and frankly all of us, that prices would begin to come down as they've been stubbornly high. As long as inflation continues to run well above the Fed target of 2%, I think it's going to be difficult for the Fed to cut interest rates as many times as folks would like to see. And currently the market's pricing in just 2 interest rate cuts of 25 basis points this year. A move in interest rates impacts bond prices, portfolio income, and interest on the debt payments. What we see in front of us is the federal budget deficit, all the way to the right-hand side. Let's focus on the last 6 years, which has reached astronomical levels. The reaction to COVID was to print money, inject that into the economy. But even after COVID, while there was a slight reduction in deficit spending, as the economy continued to rebound, the deficit spending actually accelerated. So despite very robust economic conditions, this country continues to borrow money at very elevated levels that I think is going to be difficult to sustain moving forward. The challenge to cutting government spending, of course, is that you run the risk of upsetting constituents. And this being a midterm election year, we see in orange that midterm election years historically have produced a lower expected return in the stock market than have presidential election years in blue and non-election years in the dark blue. Of course, this isn't prescriptive as to what may be ahead, but it is interesting to take note of. As is the case every January, there are headwinds, tailwinds, and sidewinds. And our job is to position your accounts as effectively as possible and to incorporate the very best wealth planning strategies to help you achieve your goals. Thanks for watching. Enjoy today.